Everyone, welcome back to the channel. Today we're going to take a look at Carvana. So recently this company kind of popped in my mind. I sold a car back in August and looked at using Carvana to sell it, but their competitor Vroom actually gave me a better offer, so I actually ended up selling it through Vroom, but then decided to buy a new car recently, or a used car, new to me, and ended up going through Carvana and just kind of looking. It seemed like cars were selling pretty quickly on the platform, and I was just kind of curious a little bit more to dive a little bit deeper into the company and just to learn a little bit more about it. So I'm going to take a little bit more of an in-depth look today and do a little valuation analysis and see what kind of price we get at for Carvana and see if it's something interesting or not, because it's definitely an interesting model. If you're not familiar, they don't really have car lots. They have car vending machines, but you can buy a car online, they ship it to you within a week, and then you have 7 days to basically drive it, and if you don't like it, you can return it for a money back refund. But they get rid of the overhead, and they're trying to be kind of a national distributor. So first thing, I went ahead and pulled in financial information for them. So they've announced through Q3 so far of 20. Their Q4 results will actually probably come out here in the next few weeks. So I could always go back and update this, but they have seen really steady and consistent quarter-over-quarter growth for basically the last 7 quarters now. And if you look at their yearly growth, right, I mean, they've been basically doubling every year. And let's see, so far through 3 months, they're basically at their entire 2019 revenue. So while they won't double it in 2020, they're definitely still going to grow. So the first thing we need to do here is we're just going to model out Q4 20. First thing we'll kind of look, I'm just going to look at some of the average year-over-year growths and get kind of a general sense of how they've been growing quarter over quarter, and then maybe apply that to, we can apply that to Q4. We'll just kind of see if, oh, yeah, no, those aren't going to work, but then we can take this, bring this over, should probably just scroll over here, just kind of see. So, I mean, annually they're growing at 100%, quarterly 40, 16, 40. Just for simplicity's sake, I'm just going to give them a top line growth here of just kind of somewhere between this 40 and this 15. So let's go with like a 25% is what we'll do here, just to kind of keep things simple here, and then we'll forecast out a little bit better for. We can forecast out better the annual growth rates when we're looking out 10 years. But this is just kind of give us a quick analysis here of a 2020 picture. You can see they actually have 3 business lines, so we'll forecast out all of these for now. So wholesale vehicle, this is going to be, my guess here, this is vehicles they purchased that, because they have a pretty loose purchase policy. You just kind of send them some basic information, they give you an offer, they come pick it up. I'm sure a handful of cars that they actually pick up they realize aren't of quality to sell, so they go sell it on in a wholesale manner. So we'll definitely, it doesn't seem to be super material, but it's definitely still a good chunk of the business. Averaging, those numbers are kind of all over the place. I think I'm just going to go with the 40% here. I'm just going to keep it kind of in the middle here of these 3 most recent. Do the same thing. Let's copy that formula down. And then they have other sales and revenue. If I knew how to spell revenue. Let me fix that over here real quick. And this template will be uploaded if you want to follow along. There will be a link in the description for where you can download it. And so other sales and revenue, my guess is this is warranties. This is probably the good stuff for margins. But averaging around 40%, I'll probably just keep it consistent, do the 40%, keep the formula. Let's copy this over. COGS, I'm assuming COGS have stayed relatively constant, but we will see. And I'll do it on net sales realistically, the warranties are probably much higher COGS percentage, but I guess if we're not seeing a material shift, and we'll just kind of look at the full years there. 92, 90, 87. So as they've been buying more cars, COGS have been going down as they've been growing, but averaging around mid-high single 80s. I can actually, I'll leave a few of these just for reference. But I'm gonna give them 85%. So we'll just do that. I think, what did I do wrong here? I did not multiply it. There we go. And based off this, I think they actually will be. Oh, wow, maybe we should have their Q4 growth higher. I just noticed here that this is less than their Q3. So maybe 25%. You know, I'm gonna give them credit. They've been growing like weeds, so I'm gonna say they're gonna continue to grow like weeds and have quarter-over-quarter growth here. But who knows? Maybe this Q3 growth was just a crazy anomaly. Not entirely sure, but we'll leave that for now. And we'll, so that basically holds our Q3 flat because of some of the stuff we have dropping just because those numbers have grown pretty strong. But you can see Q3 to Q4, right? Their Q4 top line vehicle sales was higher, but they did drop and they stayed flat there. So I think that's fair. SG&A as a percent, their SG&A is pretty high, I feel like, relative to, I mean, I don't know how it's been growing over time. It's coming down. Well, no. It's kind of all over the place. I'm going to hold it at 20% for now. Just to be a little bit more conservative here in our analysis. We'll hold that at 20% of sales. Oops. What is this? This is what? Interest expense and other. I mean, interest expense, it's around 20,000 it looks like. I'm just going to hold that steady. Other expense, they've been getting close to zero, and then they've been making money off of it. We're just going to put that at zero. I'm not giving them any credit. Anything there. And then obviously, what is this? Income provision. So they probably had some losses that they're able to write off and claim back kind of a credit. I'm just going to leave that at zero for now. So now we can actually we'll add up our 2020 pro forma, which is just going to be the sum over here. Sum all of these, copy our formulas. And this will just make linking everything up a little bit easier. Nope, that needs to be the formula. There we go. So, our projections currently still have them unprofitable. So, we'll see. And then here's some other statistics: price per vehicle, vehicle sales, markets that they're in at the end of period. Used vehicle sales in the US, this is in millions, so these are just some high-level statistics on the used market kind of category. I just pulled this up off Google. And then Carvana believes, their CEO announced in 2019 that they believe they're going to be able to get to 2 million vehicles sold. So if we actually hold the price steady, we can see how many vehicles they've sold here. So I would do this, and this is in millions. Or in thousands, sorry, so we would need to divide this by 1,000. So that would be 237,000 vehicles. So that would be about, I don't know, a tenth of what they think they can do in total. I'm not sure how many markets they've opened. I didn't scrub the 10 Qs that thoroughly. The 10K will have it here in a few weeks, most likely. But, I mean, they're growing rapidly, I think, kind of throughout the US. So, I don't think this is unreasonable. I think the big thing is they got to improve their margins, or they have to get down their SG&A expenses, right? You're sitting at 20% on a business that operates on a, what is that, like a 10% margin? So, I mean, you're never going to be profitable. Every year, their SG&A far outweighs their gross profit. So then you throw on a ton of debt because you're buying all these vehicles, using a lot of your revolving credit facility. But we'll link up some of the stuff in the DCF and we'll just kind of see what we get. First, revenues. We'll link this up. And actually, just to keep things easy, divide everything here by 1,000, just so the other page. And this is a cool trick. If you do 1,000, do Control C, and then paste special, which is Alt ES. Then you can hit divide, hit OK, and it'll divide everything. And then we can actually just come back here. We'll paste our formatting again. This way, so when we link it up, it's a little bit easier to read. Why is that not linking right? Looks like I have to divide all that by 1,000. There we go. Yeah, something's still not working here. Because this was a formula. This row shouldn't have the divide by 1,000. Okay, well, this is a nightmare. There's probably a faster way to do this, but and then I probably just have to do the exact same thing for the 2020 column. I guess. Oops. You know what? I'll format the other page. Make it easier. That was a waste of time. Okay. We'll link this up. How can I do this? Let's do it one place. That should make it a little bit easier to read. And then I just have to do the same thing down here for a couple of rows. These formats, and then depreciation amount, same thing. Sorry about that. And then for working capital. Okay, so now it should be a little bit easier to read. COGS, we'll link that up now. We can see, is that right? That doesn't make sense. Something's not linking up there. E7. Those should all be positive. E3. That should be E6, that's why. Okay. There we go. And then SG&A. Link that up now. And I'm actually gonna, maybe I'm gonna lump in other. So we are doing EBITDA, so before interest. So we're gonna leave out the interest aspect. D&A, I have on the balance sheet, not on the balance sheet, on the cash flow. 2020 we don't have. We'll have to come back to that. Just make that yellow as a reminder to come back. Use this EBIT, add back DNA, CapEx we have on the balance sheet. We'll link that up. That is, once again, not on the balance sheet, on the cash flow statement. Where do they have it? It's down here, purchase PP&E. I think I may actually need to flip the signs here. So I'll do that here in a second. This one needs to be yellow as well. Come back to it. No, sorry, that should be negative number based off how this template's set up. Cool. And then change in working capital, that'll be a schedule we build out down here. Just got all wonky. Just do that real quick. That works. Current assets, that'll be the balance sheet. So current assets, we're going to do AR, finance receivables, inventory, and we'll lump in other. That's actually this one here. Oops. Oh, annoying. My bad. Let me see, is this in? Is this in thousands? Yeah, they probably have 400 million of cars. Yeah, okay. And then current liabilities. What do we got? We got AP. That's debt, so we'll ignore that. So I mean, they really just have their AP and this other, but that's pretty small. But you can see that that is big use of cash there, huge. I mean, these things are just doubling, right, every year. So that'll be fun to model out. Okay, so we got the template set up pretty well. First, I think the big thing is forecasting out sales. The way I'm going to do that, I'm going to model it over here actually. Just going to add a few rows. There we go. So I'm going to assume they're going to kind of continue the growth of car sales, right? And we're going to see how fast are they growing that? So I mean, 30%. Okay, we're going to give them 30% for a few years. We're just going to see how that translates to a top line. So we're going to say price per vehicle. I mean, it's gone up a little bit, but I mean, I don't think they're going to start. Yeah, I'm just going to hold that kind of flat, to be honest. And then we're going to say they can keep growing at a really fast clip here, and we're going to see how many cars does that get them to. They believe they can get to 2 million. So this is what, 1, 2, 3, 4, 5, 7 years out. So here, maybe we'll do 8, 9, 10. We'll do the 10 years here. And we're gonna tweak it down a little bit. We're gonna try to get them to 2 million cars, because that's what they believe they can get. So we're gonna see if that's actually realistic. If they get there based off. Okay, so they got to grow pretty quick. So maybe we'll keep them at 30 for 2 years. We'll go 25 for 2 years, 20 for 2 years. I mean, if we drop that down, okay, 34. We'll give them 2 30s, 25, another 20, another 20. 15. We'll go, just trying to get this last year to right about 2 million, right where they think they can be. There we go. So that'll work. And then we'll just translate that to a revenue number real quick. So you can see that this was actually just based off the top line. So I do that. That's a lot of dough. That seems crazy. I didn't realize 2 million cars would translate to them doing $40 billion a year in car sales. That's aggressive, but that's fine. We'll start with that, and we'll just see where it kind of goes from there. I'm just gonna, for simplicity's sake, I'm gonna just see what's this percentage. Oh, it's all jacked up. And I'm just going to hold the percentage constant for future years. So if this is, so the other revenue is making up 15%. So we're just going to do this divided by this, and that'll give us kind of the total revenue. I mean, obviously these ancillary services would grow as well, but for now we're just going to do that. So we're actually going to link this up just to here for now. What's going on? I thought I edited all the formatting there. Oh, what did I do wrong? Oh. This needs to be divided by 1,000. Just to keep, there we go. Now it'll look more normal. I mean, it doesn't look normal at all, but it'll look more normal. So here's COGS, right? We're just going to hold COGS steady for now. SG&A. I mean, they got to become profitable eventually, so we're going to say that, no, they're not going to decrease it down to 4%, but leave it at 18 for a while. I mean, they're still, they got to get the COGS down is what's got to happen. I mean, if they improve that, I mean, they're close to being profitable this year. That's why I feel like something in here can give and they'll still be a profitable company. So it might be a little bit much at this point. So maybe we, we're going to take this down one percentage a year and just kind of see how that grows. We're going to say, they're selling more services at a higher margin percentage, something like that. SG&A, we're going to just decrease it by 0.5% a year. And then we'll have it, steady out at 15%. This way they can be cash flow positive. We can try to actually do an analysis on them, see what we can come up with. CapEx, let me link this stuff up, and then the formulas will flow through. And we can go back and kind of punch those in. So we're going to hold this, we'll hold it 6%. So is that a negative? So it's 310, so that one's in there now. I think the sheet's just set up to kind of hold that constant. Depreciation as a percent of CapEx. So yeah, I mean, it's crazy growth CapEx right now. So we're actually going to have depreciation increase because eventually they're not going to be growing like weeds as much. So we're going to have that grow until, like the 70%. So then we just have kind of minimal growth CapEx every year. We'll do that. And then we'll link this up. cash flow positive, yeah. They get cash flow positive eventually. We gotta forecast out some of this stuff. This is nuts to me. This is a percent of revenue, but I mean, it makes sense. They just buy a ton of vehicles, right? With the idea of we're going to be able to resell them to someone else, make 1,500 bucks, and move on to the next one. So 29, 6.3. So we'll hold this flat. This is not going to be a source of cash. This is going to continue to be a use of cash, but we're going to say current liabilities go up. Actually, yeah, we'll have this go down 1% a year, and we'll have that go up 1% a year until they about meet each other somewhere in the middle-ish. That way it's not this crazy use of cash every year. Things kind of look better. Gotta copy the formulas over. Why is it giving me a circular reference? This should be off revenue. Okay, whatever. I don't know what it's doing, but that's fine. Link to the wrong thing. There we go. So now you can see over time it becomes less of a use of cash and a little bit of a source of cash. So as their terms kind of improve and things get better. So we'll leave it at that. And you know, for now, we'll see what this values them at. Honestly, no clue. So this is another thing a lot of people ask about the WACC. People are like, oh, but what's the company's WACC? I mean, I think the actual company's WACC is irrelevant in a calculation like this. When you're doing a calculation like this, the WACC you're looking at is really what return do you need on this investment for you to be willing to invest in it. That's really what you're looking at. And a lot of people seem to not grasp that. They think like, oh, I need to understand like what the company cost is like for their capital. Like, no, this as an investor, you're looking at what return do I need, and you can change to the WACC and whatever percentage you use. That's if you entered that stock today at that price, you would get that return over the length of your projections if you believed your projections. So that's why I don't spend a lot of time calculating the WACC and trying to like get into an academic approach, because it's just that would be an academic approach, and honestly I don't think it's really worth the effort, and I don't think it's something that a lot of people do in practice really. At least I haven't in my time, but that's kind of where I stand on WACC. So right now we're getting, what is this, is that right? Enterprise value 14 billion. Let's add the net debt. I only pulled our 19 balance sheet. I think that's fine. Let's see, oops, I meant to hit plus, not add. So we got that. We got current portion of long-term, other long-term debt, and then we need to subtract out cash. So my guess is they're going to get a lot of value here from the debt. So $13 billion equity value. Sorry, all these symbols are all screwed up here. This template, I should have checked if it was in millions or thousands and made sure when I entered the balance sheet and everything was the same. But so depending on your perpetuity growth, your WACC, looking at, what is this, $8 billion to $30 billion valuation. And let's go ahead and actually pull them up right now. How about if I went to finance, and we'll see Carvana, what's their ticker? It's like CVNA, there we go. Pull it up, market cap, 50 billion, that's crazy. Absolutely nuts. I mean, 2017, their sales were nothing, but I mean, even if we go back to 20, at 50 a share, right, you cut their market cap, and sixth, basically, get like a $8 or $9 billion company. Okay, not bad. I mean, this is taking into their CEO's projection, saying they're going to get to 2 million cars. Maybe he thinks they're going to get there a lot quicker than I do, but I mean, that's taking 5% of the total used car market in the United States. That's a lot. And, you know, I just bought this car in Carvana, talked to my parents, told them I bought a car online. They thought I was crazy. So, you know, for millennials and anyone born after the millennials, sure. This might catch on, might work pretty well, but boomers aren't buying this. You know what I mean? I think probably someone in their late 30s is probably the cutoff for their core demographic. I'm going to guess it's probably, you know, people from the age of 38 to 25 are the core buyers on Carvana. If I had to guess, I don't know for sure, but I don't, you know, my dad's in his late 50s. He's not buying a car on Carvana. He wants to go to the dealership. He wants to test drive it. He wants to see it, especially if it's a used vehicle. Can't trust the internet, you know, things like that. So I don't know. This seems, you know, if you only needed a 7% return, you're not getting anywhere close to that $50 billion valuation that they're seeing right now. That's crazy. I was expecting them to be valued high. I looked at this. I didn't pull up their stock price recently, so I didn't really realize how high the market cap is. I guess if you make aggressive assumptions around their SG&A, right? You're like, no, they're going to cut it 3% a year until they get down to like 15%, and then they're just going to hold steady at 15%. I mean, I don't even know if that really makes it better. I mean, when you're operating on a friggin' 17% margin, I guess you got to keep cutting it. You're not going to be able to sit at, you're going to have to get this down to like, what, 8% probably? Down to 8%. I mean, you're still not there. This is nuts. Yeah, I don't know how I guess their COGS are going to keep going down. You're going to assume they're going to move higher market. They're going to make more than, I think right now their thing says they make like $1,300 a car. They're going to be able to make more. So maybe we say they start really pushing the warranties, and their COGS are going down 2% a year because they're really growing that part of the business. Plateaus at 70%. I mean, that just seems really high for selling used cars. Even then you get to the $50 billion valuation. That's pretty crazy. Now, obviously, I mean, car sales in the U.S., you know, when they hit 2 million, there will be more than 40 million sold in the U.S. probably 10 years from now. You'll probably be closer to 50 million or something, or maybe not 20% growth, 25% growth in 10 years. But, you know, the market probably grows 1 to 5% a year, something like that. So who knows? But, I mean, there it is. It's a pricey company for sure. Oh, and here, let me format that so you can look at that. And so, I mean, we're really saying their terminal value is where their value is, right? We're saying you take the $6 billion there, grow at 3% indefinitely, discounted at 10%. But yeah, I mean, I guess that's, if you believe that they're really going to take over the used car market, you know, this might be an understatement, right? They could grow to, let's say they hold up to 34% growth, and they hold that for the next 10 years, and they just grow like gangbusters, right? And they have 10% of the market. They're undervalued right now, right? I don't know, tough call. It's an interesting it's an interesting place, interesting to see how it'll all pan out, and if they can really take over kind of the used car market. I mean, we've seen CarMax in the past, but they were all city specific with kind of lots, and they would ship cars from lot to lot if you went in, things like that. And this is really just go on the internet, press a button, a week later, car shows up. And if you don't like it, you return it. So it's an interesting model. Interesting to see the numbers on a sheet of paper here, and you know, interesting to know that I probably gave them $1,500 to help out on that gross profit, and hopefully they continue to bring the cogs down. So hope you found this useful. I'm gonna try to record more videos more frequently, something I'm trying to do here in the new year. So if there's any companies you'd like to see me do a video on, let me know, leave a comment below. Thanks so much for watching.